Welcome to This Explainer. Today, we're pulling back the curtain on something totally frustrating yet totally eye-opening in the markets. We're looking at why those picture-perfect setups are actually the most dangerous and exactly how retail traders get sucked right into what we call the liquidity trap. Look, we've all been there, right? You spot the setup, you draw your resistance line, the momentum is building, and boom, the price finally bursts through. You hit buy on that textbook resistance break, completely expecting a massive rally. But nope. Instead of soaring to the moon, the price just instantly reverses, stalls out, and absolutely tanks your portfolio. You're just left sitting there staring at your screen, wondering, is this whole thing just rigged against me? Well, here's our agenda for today to figure that out. We're going to run through the false breakout illusion, the anatomy of a trap, spotting the warning signs, and finally, some real strategies to beat the trap. All right, let's jump right into section 1, the false breakout illusion. Okay, so the absolute most crucial thing here is understanding this concept of trapped traders. This happens when a huge rush of aggressive buyers just completely runs out of gas. Imagine it, FOMO is kicking in hard. Everyone sees the price creeping up to a double top or a major resistance level, and they all rush in to buy the breakout. But here's the catch. Once they've all bought in, there was literally nobody left to keep pushing that price higher. So they're suddenly stuck holding these losing positions at awful price levels. And as the market inevitably starts to drift down, their panic selling is what actually accelerates that violent reversal. Which brings us to section 2, anatomy of a trap. To really get why a false breakout happens, we got to talk about liquidity. When a major resistance level breaks, you suddenly get this massive pool of buy orders flooding in from two distinct groups at the exact same time. On the left side, you've got your eager retail breakout buyers going long. They're just hoping to catch a massive trend. And on the right side, you've got the stopped out short sellers. These are the traders who are betting against that resistance level and their stop losses just got triggered. And you've got to remember this underlying mechanical fact. A triggered stop loss for a short position is, by definition, a forced buy order. So when you combine those aggressive retail buyers with the short sellers who are literally forced to buy to cover their positions, wow, it floods the market with a staggering amount of liquidity in one single direction. And right here, this is the trap. You see, the big institutional players, the smart money, they actually need this massive wave of panic buying. Why? Because they have absolutely enormous positions to fill. If they tried to unload their huge sell orders in a normal, quiet market, the price would slip drastically, and they'd get terrible entry prices. So what do? They wait. They wait for this artificial buying frenzy right at the breakout level, and they quietly just sell right into it. They are literally using retail traders' enthusiasm as the liquidity they need to build their own massive short positions. So how do you spot the difference between a trap and the real deal? Volume. It's all about volume. Look at an initial breakout. It takes massive energy, right? High volume to break a real level. But when the price pulls back for a retest, a true retest should show low, decreasing volume. If the volume is still super high on that pullback, watch out. That's smart money aggressively stepping in, and yeah, you're almost certainly looking at a trap. Let's move on to section 3, spotting the warning signs. First things first, you've got to stop drawing these single, rigid lines for support and resistance. Look at the shift in perspective here. Amateurs will draw a perfect pencil-thin horizontal line at the exact top of a peak and just wait for the price to touch it perfectly. But support and resistance, they're battlegrounds, not exact price points. Professionals know this. They draw wider, inclusive zones that capture the whole area of congestion, including all those messy wicks. Doing this prevents you from getting stopped out by some tiny millimeter-deep fake-out before the real move even happens. Okay, so once you have your zone drawn properly, you're on the hunt for specific rejection signatures. If you spot these at a key level, a trap was just set. You might see an engulfing candle, where a breakout is instantly followed by a massive candle in the exact opposite direction. Or you might pick up on some volume clues, like really heavy volume on a breakout candle, but literally zero follow-through on the next one. And of course, there's the classic long wick. Let's actually zoom in on that wick, which is often called a pin bar. You don't just want any standard small rejection candle. Specifically, you are looking for a violently rejected pin bar where the wick is at least double the size of the body. It should clearly pierce your resistance zone and then just immediately snap back, all happening on above average volume. This paints a super clear picture. Smart money tried to push the price through, they completely failed, and now they are aggressively reversing the direction. All right, moving on to our final section, strategies to beat the trap. If you want to trade the false breakout safely, there are 3 highly mechanical steps you need to follow. Step 1,
Wait for the candle to close firmly back below the resistance level. Never try to catch the absolute top of the wick, okay? Always wait for that confirmation. Step 2, place your stop loss above the entire zone, specifically above the highest point of that fake out wick. Because look, if the price gets back up there, the setup is totally invalidated anyway. And step 3, target the opposite end of the range. If you're shorting a false breakout at the top, your target becomes the bottom of that market structure.
Now, as you're executing this, there is one absolute golden rule you have to stick to. You only trade the first retest of a level. Why? Because the very first time a level is tested, it has maximum psychological power. All those trap traders are still there, all the stops are just resting and waiting. But with every single touch after that, orders are getting filled, traders are getting stopped out, and the psychological power of that level just evaporates. It literally gets weaker with every touch, not stronger.
But hey, what if it's not a trap? What if it's actually a legit breakout? Well, if you really want to trade a successful breakout, you have to wait for a true momentum candle to firmly cross your resistance zone. By momentum candle, we're talking about one very large-bodied candle where the vast majority of the body closes outside the line, or 3 consecutive medium candles moving decisively in the exact same direction. You want to see zero hesitation here, just pure momentum.
And if you do catch that real breakout, managing your profits becomes the name of the game. Breakouts have huge upside potential, but they can be wildly volatile. So when taking profit, a really proven strategy is to sell half your shares at a 1.5 risk-to-reward ratio. This guarantees you lock in those initial gains just in case there's a sudden, nasty pullback. But more importantly, it lets you let the rest of your position run.
For that remaining half of your position, you're going to need a system to ride the trend. A great way to seamlessly manage it is by using a chandelier stop indicator. If you set the ATR multiplier to exactly 2, this tool acts as a brilliant trailing stop loss. You just let that remaining half run, riding the wave up, and you do not exit the trade until the chandelier indicator changes colors. It completely takes the emotion right out of your exit strategy.
Let's tie this all together with a core trading philosophy. Ultimately, shifting your mindset away from trying to catch every single breakout and instead focusing on hunting trapped traders, that is what aligns you directly with institutional order flow. When you stop chasing those obvious moves and start waiting to see who gets caught offside, you stop being the liquidity and you start profiting from it.
So I'm going to leave you with this thought. The very next time you see the price aggressively charging at a major, obvious resistance level, just take a breath. Ask yourself, whose money is really driving this move right now? Is it the smart money, or is it just a crowd of retail traders about to get caught? Are you about to become the bait, or are you ready to trade the trap? Keep these visual cues in mind, draw your zones, wait for the market to reveal its true hand, and you'll be on the right side of the trade.